trade pretty much in everything, but our focus is really building these portfolios to get assets under management. So your goal is going to be 5-6-fold, basically, in the class. One is to come up with first is to come up with the passive strategy for the portfolio that you're constructing. And let's see, where's the, are you guys handing out the, so here, this is going to be the cover of your passive strategy. This is the memo that goes on top of the Excel spreadsheets. So the 1 year, the 3 year, the 5 year, the 10 year, the 3 month, the 6 month, the 9 month. That's your passive strategy. So this is going to be the cover. When you staple the Excel spreadsheets here, staple it together, and that's going to be the deal with that. So you can use those out for me.
Tell me about it.
Let me know when you have these. This one. This one. And then if there's any piles of stuff laying around, you need to distribute those too. Make sure everybody gets them, okay? Thanks.
Did you just hand those out?
Yeah, they're working on it. And then who's ever presenting, you might want to load up your presentations. Did you make any, thank you. Did you make any modifications to the presentations, or are you using them turnkey?
No,
Just turnkey? Okay, you didn't add anything to it or anything like that, okay. You want to use my computer?
Sure.
You have yours already loaded up in
No, I don't.
HDMI.
Yeah.
Let me do my presentation. Why don't you get it set up? Test it, make sure it all works. All right. So you guys have the memo? Get the memo?
No, still no.
Yes, where's the other?
In the back.
Make sure all the stuff gets passed around. You have this. You have this. So this is the template you want to use for the your passive portfolio. Basically, the template is pretty straightforward. You really don't have to do anything except put your analytics in it. Okay. So you got date to me from Nick, Oscar, Daniel. Those guys are gone. It's a passive growth portfolio. We recommend DTC launch a new series of both retail and institutional large cap passive growth portfolio products. We target DTC moderate high returns with low moderate risk. Our targeted investor segments are both institutional and retail clients with an aim of a 50-50 split for 3.5 billion total AUM within 5 years. Is that realistic? The desired holding periods are 5 years for retail clients and 15 years for institutional clients. Does that seem like a reasonable holding period for those types of clients? Yeah. Our fee will be 1% of AUM. That's a little high these days because the fees are being competed away. But I would just use 1% just to make things easy, leading to a total gross fee revenue of $35 million. Can you live off that after expenses? You'll probably get half that after the expenses, so that's $15 million. Probably split the $15 million between the Fidelity and us. Okay, so we'll probably get about $7 million. So of the 5 of us, we'll probably get like $1 million each. After taxes, you're walking away with about $500,000 a year. Can you live off that? No, you can't. Yeah, so you kind of do the math, right, and see how much money it is. And if you can replicate these portfolios over again, do an active strategy and a targeted strategy, and then add in the fundamental securities analysis recommendations as a trading strategy and a recommendation, and add in the technical analysis, you could probably double or triple that 500 grand to probably come out to be about $1 million a year. That's how much these people are making. So the top table shows the 10-year, 5-year, 3-year, 1-year gross returns on the portfolio after using the back testing worksheet. And then what you're going to do is you're going to do a forward test. So there's forward test worksheets here too. So the forward test 1 is going to be, you're going to put in the March prices. The forward test 2, you're going to put in the June. And the forward test 3, you're going to put in the September numbers. So not only have we back tested the portfolio using in the target portfolio sheet, we're going to put in the January 1st prices. And then we're going to go back 1 year, January 3 years, 5 years, 10 years. And again, if you don't have stock prices going back 10 years, just use the longest. So if the stock only has 7 years of pricing, just use the initial price and put that into the 10. Okay, so at least you have numbers for all of the stocks within your portfolio. Okay, and then we're going to calculate. You're going to calculate the 1 year, the 3 year, the 5 year, and the 10-year average annual compound growth rate in the S&P 500, and to then be able to benchmark against your portfolio performance and calculate the alpha. And that's what you want at the end of the day, because everybody's going to look not only to the performance, were you able to achieve at least an 8 to 10% rate of return? Looks like Nick and Oscar and Dan blew those guys out of the water. And they beat the benchmark over the last 10 years, and usually I go back and I look at the 10-year. So if I'm ever recommending to a client an ETF or a portfolio or a mutual fund, I'd like to see at least 10 years of history. So I have at least a couple cycles within the performance, and their portfolio was able to beat the S&P 500 by 604 basis points per year consistently over time. These guys are going to get probably $4 billion in AUM in this portfolio. Because if you can beat the market by that much, the money's going to come in, okay? And it's very efficient running these portfolios because it only takes 5 people to run a multi-billion-dollar portfolio, because you just need a couple of analysts and a portfolio manager, or maybe 2 portfolio managers, so the head count's not very high, and you're using all computers and stuff. So that 1 month forward test is going to be 3 month, 6 month, and 9 month, okay, on this. And then in the worksheet, off to the side, in the target portfolio, you put in the betas for each of the stocks, and it calculates a weighted beta for your portfolio. So in this case, the beta was 0.84 with an alpha of 604 basis points on the 10-year. That's pretty damn good. It's less than, the beta is less than the market. So I'm getting less risk, less systematic risk, and I'm beating the market. That's pretty darn good. And we're not even trading this stuff. This is just a passive strategy. So I was pretty impressed with the composition of this portfolio. Then we have the strategy broken out by sectors. So we know the companies by sector, we know the sector weights, and we know the company weights within the sectors. So this gives you basically your portfolio composition that communicates, is your portfolio high risk, moderate risk, low risk? Is it high return, moderate return, low return? What are you trying to sell? You know, what segments of the marketplace are you trying to sell? Portfolio is purely large cap and mostly domestic, with moderate to low risk and consistent annual returns of 600 to 700 basis points over the S&P 500, which is your benchmark. Target market, we were targeting individuals and institutions looking for stable product to add to their 401ks, IRAs, and other retirement accounts, or more volatile portfolios. Our product also has the potential to be turned into an ETF in the future. So now they're thinking about other product development and other product opportunities as a derivative from this core portfolio that they're going to be developing. The target portfolio size we hope to raise, and I wouldn't put hope, I would put will. We will raise a $3.5 billion fund with an AUM split evenly between retail and institutional clients at roughly 1.75 billion each. The holding period, retail investors 5 to 7 years, and institutional 15 to 30. So that's basically your memo. Everything's there. Okay? Everything's there except for the internal split information and the expenses, right? Because we got gross fees, we got to take out the expenses, right? And then we got to split the net revenue between the house and us. And then I would probably get slightly a little bit more being the CEO of the company. But again, you would get a significant portion of the revenue splits too. All right. So once you get your portfolio set up, and does everybody have their portfolio strategy and their portfolio set up? You really want to have those down, by this weekend. All right. Because I called Elizabeth at Equity Sim. Okay. And basically what she's going to walk us through, you should register and you should put your tickers in. Everybody should do their own account through Equity Sim, okay, using my class's number, okay, the BizAd 136. Create your own individual accounts with the stocks that you've chosen as your portfolio strategy, and then start trading those securities. So what I did was I talked to Elizabeth today, and I said, what are the categories and the justifications and the rationales for my students to be trading these securities, okay? Because once you put the securities in, you're gonna start buying and selling these things, or going short or going on margin. And they're gonna look at the logic, you'll be typing in the logic, why you bought and why you sold the security, okay? And they're gonna do a scan, they got machine learning and content analysis, where they will scan your content. And if your content and your rationale is up to a level of competency, then at the end of the semester, what they will do is they will forward that information on to the hiring firms, and you will get a call from them in regards to an internship, okay? And hopefully we're gonna be smarter than a lot of the other schools that are competing, for these slots. So I came up with the factors for trading criteria to start trading these securities. One would be just macro factors, kind of like a arbitrage pricing theory, to be able to forecast expected returns for the individual stocks. You would be using APT. And APT basically is a cross-sectional regression methodology that forecasts expected returns for individual stocks based on macro factors, okay, factors. So interest rate environment, so if you're trading financial services, obviously interest rate movements and net interest margin is going to have an impact on the stocks if you pick financial services. And obviously Fed policy will have impacts on certain segments of the economy and certain segments of the stock market, so you're going to have to kind of understand, if Jerome Powell says that, they're going to be raising interest rates 25 basis points over the next 12 months 3 times, and it inverts the curve, what impact is that going to have on the individual stocks within your portfolio, and can you trade on that information? You need to put that in there. Obviously, when GDP and industrial production is reported, it was at 4.1, 4.2 just released in the last quarter. You've got to analyze your portfolio and make a justification based off the macro factors of what stocks within the portfolio will benefit the most from a peaking or a hyper-growth, economic environment. You got consumer confidence indexes that just came out that are at the highest they've been in 18 years. Obviously, that's going to bode well for the consumer product sector and the retail sector, if those are part of your, your composition of your portfolios. You got the unemployment rate. What was the jobs numbers today? They were estimated 116. Were they over 200? Get on the computers, find the numbers. They just came out. What was the unemployment rate? I think it was at 3.8, 3.9. You need to find the information. You need to go online. What was it, Kimberly? 3.9, and then what was the jobs number for the month? 116, 108, 19 was like was the consensus. Was it 200? It's 200, that bodes extremely well for wage growth in the consumer sector, since 75%, 70% of the economy is consumption-based. Wage growth. Wage growth actually was reported also, supposedly real wage growth is still stagnant. So you got low unemployment, good job growth, but you still have stagnant jobs, unfortunately. Inflation should be put in there too. And then obviously capital flows. You know, if you're dealing with multinational corporations with large international footprints, obviously they're going to be subjected to capital inflows, outflows, and obviously the volatility or exchange rate differentials. Okay, so you got to be looking at that. And then the fundamental analysis, we're in what, September? At the end of September, there's going to be earnings releases. And those earnings releases will have a definite impact on the stock prices. So you want to be on top of your stocks as the earnings releases come out so that you can trade them based on did they meet or beat or miss, you know, their earnings expectations or anything else that comes out around those companies, particularly the press releases, forward guidance, and then any news. I mean, Tesla would be one example of probably a short or a buy a put or write a call position on that. The financial ratio analysis, when the quarterly reports come out, they're going to update the financial ratios, and you're going to look at the ROE, ROA, you're going to look at the quick ratio, maybe the some of the liquidity ratios, you're going to look at the leverage ratios, but ROE and probably leverage ratios are going to be two of the main components there that you're looking at, and the multiples, obviously. And then intrinsic valuation, I already gave you that spreadsheet, so you may want to go ahead and start looking at the fundamental securities analysis so that you can automate the fundamental securities analysis for the 25 stocks. If you put in, you really don't have to mess with really too much with the multiples. You really don't have to really mess too much with the discount rates. You probably do need to mess a little bit with the terminal growth rates to get the terminal values on the end. You got to put in the 2017 EPS or EBITDA, you know, per share or whatever metric you're using, and then you have to project out what those cash flow growth rates are going to be over the 5-year holding period. If you do that for your stocks, you're going to be able to figure out what stocks you're projecting to trade at a premium in the next year. And you're going to rank your stocks by premium, intrinsic value to stock price, premium or discount, and you're going to overweight and you're going to trade and probably over-concentrate in your portfolio and probably trade, you know, take some bold trades on the ones that you think are going to be at a premium over the next 12 months. And then your 10, 30-day, 50-day moving average crossover system, those will also be signaling buy-sell recommendations too from that. Okay, so you can use that as justification within why you made those trades. So you got macro factors, you got fundamental analysis, and you got technical analysis. And you can use, you know, MACD, RSI movements to be able to predict where the stock price is going to go, some price trends. Is it in a trading range? Has it broken out to the upside, downside? Is it hitting resistance? Is it hitting supports? Is it forming a head and shoulders? Is the trading volume there? Is there trading momentum? And you can use other technical security analyst tools if you want to borrow my technical security analyst library. You can borrow this if you want to become a little bit more competent in the technical trading methodologies. Okay? How much time do I have? I want to have time for the presentations. Okay. How long do you think your presentations will take?
15, 20.
Okay, perfect. So see if you can do it to 10. Okay. So does everybody know how to calculate average annual compound growth rates? Does everybody know how to calculate the average annual compound growth rate? Does everybody know how to calculate an average annual compound growth rate? Okay, I'm not seeing anybody say yes. I only see 2 people saying yes, so I can't read your mind, okay? So when you don't say anything, I'm gonna assume you don't know anything. So, do you know how to calculate the average annual compound growth rate?
Can I go over it?
Yep, I'll go over it. Just say no, okay, so I can know, right? Or say yes. So I'm gonna do the 3-year. 3-year really quickly. And then the people that are presenting, you may want to get up there. S&P 500, 2018. You can use let's say you use January.
Isn't this what you showed us the other day?
January 1st. Okay, got it. Then you're going to take the index level. You're going to divide that by January 1st. MAH01322. And that's gonna be January 1st, 2017. Got it. So I got, oh no, sorry, that's not 17. We're gonna do the 3 year. 18, 17, 16, 15. Got it. So you're gonna divide the index, the most recent period, by the base period, okay? And then since this is a 3 year, you're gonna take it to the 1/3, okay? And then you're gonna subtract out 1. And you're gonna multiply it by 100. And this is gonna be X point X, average annual compound growth rate for the 3 year. Okay? And then you change this to 5. Go back to 7, what is it? 13, right? You rerun it, now you got the 5 year. Divide by 10, go back 10 years, average annual compound growth rate. So you need to go back into these back test sheets and do the January to January. And what I would do is actually go in here and build a formula, right? Build the formula so that that's all you got to change is basically the base period and the exponential, right? And then copy it into your spreadsheet, do the 3 year, the 5 year, and the 10 year. Now you got your average annual compound growth rate set up. And then when you back test your portfolio, the alpha's going to kick out. Right? The alpha's already there. And then in the forward test, you got to do the same thing. So you're going to do 3 months, 6 months, 9 months. And then you're going to put in the 3-month return from January to March for the S&P 500 to get the alpha over the 3 months. Then you're going to do the 6-month S&P 500 against your portfolio, kick out the alpha, and then you're going to do the 9 months.
So it wouldn't be 1/3, right? What would it be?
Huh?
What would it be if you're doing the 3 months?
If you're doing the 3 months, it's just a percentage change.
Okay.
Okay, in the 6 months, it's just a percentage change between January and June, and then January and September. So you're doing a run rate. Okay, so you're comparing the performance over time, year to date, so they're year to dates. Okay, all right. So that's all I wanted to cover today. And then Monday, I'd like to see I'd like to hear from each of you your portfolio strategy, and if you do have the Excel spreadsheets, I'd like to see the Excel spreadsheets. And then I want to hear the strategy. And if you've already shown me some of the benchmarking, that would be awesome. And then we'll get Elizabeth on the phone. We'll get you guys registered, start putting the stocks in there, and then maybe we spend a little time every class hearing from the others, from everybody, what you're trading and what your rationale was, so that we can put those rationales in there, so that we can score really high so that we can get the jobs at JP Morgan. Okay, all right, go ahead, sorry about that. And speak loud, please. And if we don't get through all the presentations, we'll do it on Monday, and we're going to do a lab on Monday. So lab Mondays, problem Wednesdays, and then presentation Fridays. Okay, we'll be good. Okay.
Alright, so we're gonna be going over chapter 4, which talks about the mutual funds and other investment companies. So the chapter overview is gonna talk about types of investment companies, mutual funds, and then like within mutual funds, there's functions, investment styles and policies, investment costs, performance, and then sources of information. And then within investment companies, it talks about how pool funds of individual investors invest in a wide range of securities and other assets, and the services that are provided are record keeping and administration, diversification and divisibility, professional management, and then lower transaction costs. And then there's 3 companies that branch out of the investment companies, which are unit investment trusts, managed investment companies, and then other investment organizations. And then the net asset value is the value of each share in the investment company, and the calculation to find that is market value of assets minus liabilities over shares outstanding. And then in unit investment trust, there's a fixed portfolio of uniform assets assets, they're unmanaged, and it's declined from 105 billion in 1990 to 904 billion in 2016.
So there's also these open-ended and closed-ended strategies. So what the open-ended does is it issues shares when investors buy or redeem shares when investors cash out, priced at the NAV, which is the net asset value. For the closed-end, shares outstanding are constant, and investors cash out by selling to new investors. They're priced at a premium or discount to the net asset value. Also, there are commingled funds, which are partnerships of investors that pull funds together. There are REITs, which is a real estate investment trust that is similar to a closed-end fund. They invest in real estate or loans secured by real estate. Most of them are highly leveraged with a typical debt ratio of 70%. It also goes over hedge funds, which are commonly structured as private partnerships and thus subject to only minimal SEC regulation. Hedge funds allow private investors to pool assets to be invested by a fund manager. So right here you can see what these other sectors there are in investment companies. As you can see, the open-ended mutual funds have the money market, the equity, the sector, the bond, international, balanced and fund of funds, asset allocation and flexible, and the index. So the money market is these funds invest in the money market securities such as commercial paper, repurchase agreements, or certificates of deposit. Equity funds are invested in primarily in stock. The sector is the equity funds that concentrate on a particular industry, and then the bonds concentrate in the fixed income sector.
International funds invest in securities that are international and outside of the United States. These international funds can also be emerging market funds in developing countries. Balanced funds are asset classes that are viewed across multiple things. These can be from aggressive to conservative funds. Funds of funds are mutual funds that invest solely within other funds. And asset allocation is allocating your assets in different types of classes. And this can depend on from manager to manager and can also vary from outlook on performance. Indexes are just some indexes, such as like the S&P, just track the market and the performance of the broader market, the good one is the S&P 500. Here's just a graph of just the allocations of different mutual funds. And obviously, as you can see, the total equity funds and bond funds kind of make up most of the market. Funds are sold. Direct marketed funds are funds where brokers kind of take and market the funds specifically to the retail investor. This can also be institutional. Salesforce distributed it's not a sales force, but it's actually a bunch of people kind of marketing these funds. Now, Salesforce is kind of weird because there's a weird conflict of interest between the revenue sharing of the broker and then the person marketing is like it's also commission based. So I were to market a fund to you, but I could also take a little bit of the revenue from the person in the fund that you're investing in. But it may not be the right fund for you because I'm getting revenue if you invest in that specific fund. And financial supermarkets are complexes of different funds which are sold in groups. Fee structures vary. Operating expenses, also known as like your expense ratio, can be of the administrative fees which you take when you own your fund. A front-end load is when you buy into a fund, it's that fee to buy in, and back-end load is the fee to expense out, like an exit fee. And a 12b1 charge is the charge that the SEC states that administrators and fund managers can take their fees directly from the fund. They don't have to ask for the money obviously fees and fee structures must be disclosed in your book. Here are just a picture. This is just a picture of front-end load and back-end load fees. It's really important to note that there are also no-load funds, which don't have any front-end or back-end load fees. However, in those types of funds, 12b1 fees are much higher, and your distribution of fees really affects how your fund performance does. And here's just an example of the return on a mutual fund. You can look at this. It's just net asset value plus your distributions over your initial net asset value, and there's an example. Yeah, as I mentioned before, depending on your no-load fees or front-load fees, the performance of your mutual fund can really vary. If you just look at the 20-year number at the bottom, from 88,000 all the way down to 74,000 for that fund C at the end has an 8% load, so at a 1% expense ratio, it can really affect long-term. Pass-through status is just that taxes are paid only by the investor and not the manager. There's no double taxing on that area. And the problem with this is that in a mutual fund, if the investor decides to pull out or get in at certain times, it can be really tax inefficient. You cannot, if you were an individual investor, you can time when you want to pull out your funds to make it tax beneficial for yourself. But the mutual funds with high turnover ratios can mean that you're paying a lot of taxes on exits and entries, and this can obviously affect performance in the long run. ETFs, common examples are the spiders, diamonds, and cubes, S&P 500, QQQ, which is the Q, and the diamonds are the Dow Jones. Now, ETFs are traded continuously like stocks, as you know. They can also be sold short and purchased on margin. They're very tax efficient, and lately Fidelity actually cut down its ETF fees for a no-fee ETF. However, they're pulling fees back when they split and cut the ETF distribution across their own assets. So that's how they're actually making money. They just switched their money stream, just not the investment. Potential disadvantages of it is it must be purchased from a broker, so the broker will still get that bid-ask spread on that price, and your net asset value is something you cannot control because you won't be going to a specific mutual fund. Now, ETFs have been growing over time. Warren Buffett's bet against Cedar, it's the big one. He won $10 million and donated it to a charity that his passive ETF would beat at 10 actively traded hedge funds. That's a big one. Now, investment company assets under management, as you can see, mutual funds just kind of outweigh most of the funds out there. Yeah, there's mixed results in performance of actively managed funds. There's a trend that if you have been actively outperforming the market in the last 10 years, you will continue to outperform the market. However, the probability that you are under the benchmark increases your probability that you will continue to be exponentially lower under the benchmark, which is why passive investing has become really popular. This is just the Wilshire 5000. The equities are kind of spread out across all sectors and industries. As I said before, the top half of successive period performance is really high if you're above it, and really high if you're below it. Because if you fail to beat the benchmark, you continue to fail to beat the benchmark. And this is just information on your fund prospectus. The investment advisor and the portfolio manager must disclaim costs and fees, and the funds also must report an annual report to the SEC. And this is just where you can find information on mutual funds. Cool. Thank you.
So if you want to look at some mutual funds or ETFs as examples for portfolio strategies, you can go to the fact sheet. I wouldn't read the prospectus, it's too long. And then the emergence of really mutual funds in the early 1980s was a direct was directly related to the technological advances in computer processing speed in storage. And so it wasn't until like the 80s that you had desktop computers that could actually run, or mini mainframe computers that could actually run Markowitz's quadratic optimization, which is basically a factorial combinations. So there wasn't enough technology, processing, or storage to be able to run his algorithms. So that he invented basically modern portfolio theory in 1957, and it wasn't until the early 80s for it to actually be commercialized and create an industry. Who's going next? While you guys are getting set up, and how much time do we have?
Math.
20 minutes?
25.
Okay.
Yeah.
Anybody else interested in taking the SIU? You work with us? You want to take it, Jacob? Okay, I posted the information up on the course yesterday. Okay. I have while you guys are getting set up, I got a FDIC, which is the Deposit Insurance Corporation. I have an internship. Unfortunately, the deadline for this one was yesterday, but it doesn't matter, I would still apply to it. I have a Summer Equity Research Associate position at Dodge & Cox, which is what everybody's been begging me for, is equity research analyst positions. Here it is, right here. And I also have a corporate financial analyst internship at Workday. Okay. Anybody interested in any of these?
Workday.
Which one?
Workday.
Okay.
The equity one?
Dodge & Cox. Anybody interested in the FDIC? Anybody?
Find it on Handshake anymore.
No, did it go down?
I just typed in FDIC and there's nothing.
That's not there anymore.
Yeah.
Okay. Well, we get stuff every day. Do you have some examples of some memos? Some of you, it's an update. For some of you, it's a new thing. Okay. And then I'm going to work on the derivatives. Do you want to, for your portfolios, your equity sim portfolios, do you want to trade derivative contracts off of those? You want to be able to buy and write puts and calls? Why not? So remind me that when we talk to her, to see, I'll call her too and find out if we can do that, but why not?
Why not?
I mean, that would be awesome. And we can walk through some of the strategies of writing and buying the puts and the calls and creating straddles and spreads and those things too. You ready?
I'm ready.
Okay.
All right, so we're presenting chapter 5 on risk return and historical record. We're going to be going over interest rate determinants, rates of return for different holding periods, risk and return premiums, estimations of return and risk, normal distribution, historic return on risk and portfolios. So starting off with the interest rate determinants. All right, so there's 3 determinants for interest rates. That'd be supply, demand, and government's net demand. For supply, there's households. For demand, you have businesses, and then for government's net demand, you have Federal Reserve actions. For nominal interest rate, that is the growth rate of your money versus the real interest rate, which is the growth rate of your purchasing power. Nominal rate minus interest rate over 1 plus the interest rate is the formula shown right there. Here's a graph showing how to determine the equilibrium of the real interest rate. And yeah.
So as the inflation rate increases, investors will demand higher nominal rates of return. If the interest denotes expectations of inflation, then we got the Fisher equation right here. And then on the next slide, you have taxes and liabilities are based on nominal income, and then this is the equation that will show the relationship of tax liabilities based on nominal income. And nominal income, with that being said, after-tax rate will fall as inflation rises. It's the relationship between the two. Here's just an example with a 7% nominal interest rate and a 3.5% interest rate and a 40% tax rate. Therefore, you have a 3.5 real interest rate. This equation shows that how to get the total risk-free return by having the par over price times maturity, then subtracting it by 1. And here we have examples on how to get the total return when it varies over time, given for each horizon. And then, the EAR, the effective annual rate, is the percentage increase in funds invested over a 1-year horizon. And the APR, analyzed percentage rate, is annualizing using simple interest. And these are the two equations for that. And then here we have a chart showing the differences between APR and EAR, given different scenarios.
So this chart shows the relationship between the T-bill rates, inflation rates, and real rates from 26 to 2015. Even moderate inflation offsets most nominal gains on low-risk investments. So for example, a $1 increase in T-bills grew to 20, 25, and 89 years, but it only had a real value of $1.55. This shows a negative correlation between real interest rates and nominal interest rates, but it doesn't fully compensate investors for it. So this graph shows us both the T-bills and inflation rates starting in 1926 and then obviously ending in 2015. So this is the formula showing us how to get the holding period return, and P0 is the beginning price, then you have the expected ending price and the expected dividend during period 1. Okay, this is just continued. Therefore, if you plug in the numbers, you solve, you get a yield of 10% plus a dividend yield of 4%, which gives you 14% total. So this is the formula for computing the expected return with multiplying the sum of the probability of state and state. This shows the different scenarios based on the condition of the state. So here are the formulas for variance and standard deviation. And then here's an example of how to calculate the standard deviation and the variance. So when dealing with the time series analysis of past rates of return, one must know that true means and variances are unobservable, and means and variables must be estimated. And now you can see the formula for the arithmetic average. And then yeah, there's the geometric average as well. And then here are some more formulas. So excess return is the difference in any particular period between the actual rate of return on a risky asset and the actual risk-free rate. The risk premium is the difference between the expected HPR on a risky asset and the risk-free rate. And then the Sharpe ratio is risk premium divided by the standard deviation of excess returns. And then this graph shows the normal distribution curve with the mean and standard deviation.
for normal distribution, you click. When dealing with investment management, it is easier with nominal or normal returns. Systematic returns use standard deviation to measure risk, allowing for portfolio returns to be higher. And as Neil mentioned, only the mean and the standard deviation need to be estimated to predict the future scenarios. Parallelized correlation coefficients summarize dependence of returns across securities. So now we're talking about normality and risk measures. Although if excess returns are not normally distributed, the standard deviation is no longer a complete measure of risk. Skew and kurtosis change up the formula. The skew formula should show up. That's a skew formula for the average, and then kurtosis. And then skew ratio is the average cube deviations from the sample average, also called the third moment. And then kurtosis calculates the likelihood of extreme values on either side of the mean. And then Sharpe ratio is not a complete measure of portfolio performance. You can see with these graphs the difference between a normal and skew distribution. And then here are examples of a normal and a fat tail distribution. And then VAR, or value at risk, is the loss corresponding to a very low percentile of the entire return distribution, such as the 5th or 1st percentile return. And expected shortfalls, or ES, is also called the conditional tail expectation, CTE, not to be confused with the head injury. Focuses on the expected loss in the worst case scenario. And then more conservative measures of downside risk and VAR. So the lower partial standard deviation, or LPSD, is similar to using standard deviation, but only uses a negative deviations from the risk-free return, thus addressing the asymmetry and returns issue. Sortino ratio is the ratio of average excess return to LPSD. Here shows different historic returns of risky portfolios between T-bills, T-bonds, and stocks. And then here are the chart that shows the distributions between treasury bonds and bills. The second half of the 20th century offered the highest average rate of return. Firm capitalization is highly skewed to the right, many small but few gigantic firms. Average realized returns have generally been higher or small stocks versus large stocks. This chart shows the annual returns based on percent of observations given. And then in historical returns of risky portfolios, in risky portfolios, normal distributions are generally a good approximation of returns, although negative skew is present in some portfolios, and positive kurtosis is present in all of them. And lastly, we have a chart showing countries and their risk premium over the last 25 years. The United States is somewhere in the middle and a little riskier than most other countries on there, but still a good job. That's it.
Test question. I have collected some return data. I gotta run mean variance analysis on it. And my distribution is skewed. Obviously, I need to normalize the distribution. How would I do that? Can I run the mean and the variance on this, and is the mean and the variance going to be accurate if I have a long tail? If I have outliers? No. So I'm going to need to do what? It's a test question. Increasing the sample size probably would do that, but let's say I'm limited to the data set that I currently have. So I have to deal with this, skewed distribution. So what do I do? How do I solve? How do I clean up the data? Are you going to have clean, nicely behaved data? Never. Okay, you're always gonna be dealing with errors and problems with your data set. So the skewness in the distribution can be due to errors. So how do you clean up the data set? How do you get it back to normal? Nice. So what I could do is z-score. So basically take the actual return minus the mean return, and I'm gonna divide it by the standard deviation, and I'm gonna get the z-score, and that's gonna normalize the distribution. Got it. I mean, can I hack out? Can I do maybe a two standard deviation or some kind of filtering process here and eliminate these, and then convert it back and recalculate the mean and the standard deviation? Can I do that? Can I do that to clean it up? Okay, what's another method that I could use to clean this up? Could I log the returns? Could I log them? Could I apply a base 10 logarithm
Yeah.
on them to normalize it, get a normal distribution, and then filter out on two sides, picking a 1.5 or 1.85 or two standard deviations in the log data, throw out the outliers, convert it back, and then calculate the mean and the standard deviation using a normal distribution? Can I do that? Yeah. Okay. And that's why before you do any of the data analysis, you're going to use the stem leaves and the box plots and the histograms. You're going to do data visualization to see the distributions and the behavior of the data. So you're going to actually look at it using those techniques, and then you're going to apply some type of filtering process on the data to clean it up, to then get it to where you can start applying the statistics to get the information you need to make the recommendation, or to act on the information that's being set forth through the statistics output. Okay, I think that's it. That's all I got for today. So bring your spreadsheets. I'll go around and audit them and work with you.